Welcome to all of you, and thank you for joining us. My name is Con Hurley. I'm the director of the Center for Finance, Law, and Policy here at Boston University. This center is an interdisciplinary center within the university, calling together the talents of the law school, the School of Management, College of Arts and Sciences, Metropolitan College, College of Communication, and so on, all dealing with the very vibrant and important subject of finance and policy. How many of you here watched the presidential debate last night?
Oh, yes.
Okay, almost no one didn't. How many of you heard the lively discussion that was held on the euro as part of that presidential debate last night? That's right, because it didn't come up. And yet, another show of hands. How many of you think that the future of the euro was a very important topic and is a very important topic for discussion in our presidential campaign? Fewer. Well, I'm sure you would all agree that it has a tremendous impact on our future in a shrinking, integrated world. Our history, the history of the United States, has many parallels. As you go down the Commonwealth Mall, almost to the Public Garden, you'll see a very prominent statue dedicated to Alexander Hamilton. And when we think about the challenges facing the young republic centuries ago here, there are tremendous parallels with the situation in Europe, with the questions of fiscal policy, regulation of banking institutions, the very existence of banking institutions. So when we hear Professor Dooley talk, we might think of our own history and some of those parallels. Professor Dooley and I go way back. We're at that stage in life where way back, we don't like to hear that term used. We go back to our times at the Federal Reserve together when I was a young lawyer there and he was a young economist in the international area. He went on from the Fed to work for 20 years in the Washington area, both at the Fed and the International Monetary Fund and so on. Found his way to the University of California at Santa Cruz and has become a world-renowned figure in the area of capital flows, debt management, so on. And he is also affiliated with the National Bureau of Economic Research right across the river. He's also a magician. One of his magic tricks that I saw him perform many times, we used to play tennis together. And magically, when we would change courts, the lines of the court on his side would shrink. So it became very difficult to hit the ball within the bounds as he saw them. He has a very keen eye, not only for tennis court lines, but for economics and politics and policy. And I can guarantee you that we will all come away today more informed and more comfortable with the issues facing the euro. Now, Professor Dooley has agreed to talk for a while and answer some questions at the end. So please do me a favor. I know this is a very lively crowd, and help us avoid that awful, awkward, pregnant pause where the speaker says, "Are there any questions?" And I expect at least 30 hands to go up, okay? So be thinking of them, all right? I give you Professor Dooley.
Thank you. I'd like to thank the Center for the opportunity to talk here today. This is a topic which is on a lot of people's minds. The other thing I do is I'm also a partner in a hedge fund in San Francisco. So I bet on some of the things I'm going to talk about today. I don't know if that makes me more or less qualified, I don't know, but it gives you another perspective. So the general what's on everybody's mind is, can the euro system last? What are the costs and benefits to different members of the system that might keep them in or cause them to exit. So in our first, I usually do this with a PowerPoint. So the bottom picture of the page is kind of an introduction. The gentleman on the left there is the finance minister of Greece in the new uniform issued to all finance ministers in the periphery. And the gentleman on the right is an economics professor from Athens University who was explaining to the finance minister what he thinks of the euro system and the basic logic behind it. And I think an economics professor probably has some points. So the first thing I want to go through is very briefly, where the euro system came from. First of all, I'm sure you all know it's a common currency. Just like in the United States, we have one currency for 50 states. The euro is the common currency for Europe. It has its own central bank, the ECB, the European Central Bank, which is pretty much equivalent to the Federal Reserve System in the United States. Europe is about the same size as the U.S. The European Central Bank is a very similar institution to the Federal Reserve System. And together, the Fed and the ECB, with lesser emphasis from the Bank of Japan and the Bank of England, pretty much determine how financial markets function in the world. So where did this come from? As Kahn suggested, there was a time, obviously there were 13 colonies at one time. The United States of America, when it was formed, had debts outstanding from the various colonies. They had no central bank. They faced a lot of the same issues that the Europeans are facing today. And Alexander Hamilton, the statue, was really designed and pushed our system through, which seems so natural to us now. In fact, it didn't seem natural to the people at the time at all, whether you should have a unified central financial power or financial system among the 13 colonies or the 13 states. In Europe, the history is a little different, obviously, but there's two things which are very important for understanding what's going on now. The first was under the old Bretton Woods system that was put in place after World War II. We had fixed exchange rates among the major currencies. The Europeans never wanted to move from that system. They have always highly valued stability in monetary and financial affairs. And in 1974, when the U.S. really pushed the world to floating exchange rates, at least the industrial countries, the Europeans started almost right away trying to reestablish fixed exchange rates among their currencies. They had a whole series of agreements among themselves to fix the exchange rates, and they found that they were not very successful. It's interesting, if we look back now, from the very beginning, they wanted to unify their markets and fix their exchange rates among their currencies. They met one failure after another. The fundamental problem, as they saw it, was that devaluation, that is, lowering the value of your currency when you got into trouble, and trouble generally meant you borrowed too much to finance a war or something, was too easy. Okay? You could say, I'm not going to devalue, all of you are too young, except for Kahn and me. But remember, the Bank of England there's a gentleman in the back, good, thanks. We probably remember this. The Bank of England would say, we will never devalue pounds, never, never, never. We'll sacrifice our grandmothers in the street before we devalue the currency. And then that weekend, they would devalue the currency. And this happened over and over and over again. So devaluation is easy, one way to, and you have this long-standing desire for stability. One answer to that is to eliminate the currencies. You can't devalue, if you all have the same currency, California can't devalue the California dollar against the rest of us dollars. They're stuck with that. Well, more to the point right now, the state of Illinois, which is virtually bankrupt, looks a lot like Spain. It cannot devalue their other dollar standard. And so one of the reasons that the Europeans opted for a single currency was that it considerably upped the ante to drop out of the system. So if I make a promise to you that I'm going to maintain my price level the same as Germany's, it's much harder for me to break that promise if we have a common currency. Obviously, there's the exchange rate between a Greek euro and a German euro is always 1. Right? It's the same currency, so you can't, there's nothing you can do about it. The argument was that this would provide the necessary discipline for the different states in the European community to stick to their promises of financial stability. And that was the paramount, that was at least one of the two paramount objectives. The second, interestingly, which is probably less well known, or you still see it occasionally, is that Germany wanted to reunify politically with East Germany. The Europeans did not want another independent, politically independent Germany. They taught them a lesson in 1917. They had to teach them a lesson again in 1945. There was not going to be a reunification of Germany unless they ceded a lot of political power and became a part of a union. And Germans in particularly, the German elite, the people that run the country, really remember that. To them, their commitment to a monetary and political union in Europe was the quid pro quo for reunification of Germany. That it would not have happened without it. And therefore, the Germans are willing to pay a lot to keep this agreement together. And I think they will. We'll see that later. So what actually happened? Economists, like, not so much myself, but some of my friends, pointed out, however, that while those two objectives were important, that the European Union didn't have any of the characteristics that you would normally associate with a successful monetary union. So what does that mean? Well, in a monetary union, you give up independent monetary policy. To some extent, you give up independent fiscal policy. You give up the ability to micromanage your own economy. Well, if in all your history, your economies have behaved very differently over time, and you don't have a lot of trade with some of them, and you have very different institutional arrangements, very different financial markets, so on and so forth, that group of countries you would normally think is not a very good candidate for a monetary union because there's going to be all kinds of problems to get together. Well, some of my friends at the top picture on your next page summarizes all those things for various hypothetical monetary unions. This is meant to be a more amusing part of the talk, so indulge me and at least smile. Okay, so what economists do, they add up all these things, propose a bunch of countries and say, let's make this bunch of countries into a monetary union. And they give you a score. Well, if you have a similar business cycle or similar financial legal system, you get a high score, blah, blah, blah. So some of these make sort of sense. Some are sensible, like Latin American market economies. That's way over there on the left, right? They get a very good score. A low score is good in this case. Those economies seem ex ante to fit together. They make a good currency union. And as we move to the right, we become more and more almost silly, right, about how to form a monetary union. GCC is the Gulf Cooperation Council. That makes a lot of sense because they're all oil producers. They have the same. But then when we get over toward the right here, we get the Ottoman Empire in 1880. Right? So take the countries that comprised the Ottoman Empire in 1880, put them together, and they get actually a reasonably good score as a monetary union. You move further to the right, you get even sillier ones. Countries beginning with the letter M. That's a pretty random selection of countries. They get not a good score, but not a terrible one. And to the far right with the black bar, guess what? The EU. Okay. What this suggests is what a lot of economists have said at the time and are re-emphasizing recently. Marty Feldstein, probably the guy that runs the NBER, or did run the NBER, most vocally and on most op-ed pages, said this monetary union never made any sense in the first place. All right? Now, what does that mean? Well, it means that given the structure of these economies, that number one, that it would be very costly to give up your monetary independence and all adopt a common currency. Why? Because with a common currency, among other things, you only have one monetary policy. And one monetary policy is not going to be appropriate for these very different countries. This is the prediction ex ante, and this is what's happened. Okay, so the if there the main message here is the drive for a monetary union in Europe did not come from the economics of it, for sure. So the joke last week was, sure, the EU got the Peace Prize, the Nobel Peace Prize, but it sure didn't get the economics prize because they had an exactly opposite thing. Well, certainly as I said, one of the factors driving this was that single currency was that it would provide fiscal discipline. And you can imagine, before the monetary union, everybody had their own currency. Countries like Italy, central banks did not have great reputations, paid very high interest rates for government debt in particular, because people worried that they would use their independent monetary policy to devalue the currency, and therefore they pay high rates. If you could somehow take on the discipline or the reputation from the Bundesbank, from the Germans, so the story goes, your interest rates would fall and you'd be a lot better off. And that's what happened. They joined together, and there was almost an immediate convergence of interest rates across the European unions. That there had been as much as 400 basis points differential, 4% differential between the government borrowing rates. It collapsed to almost zero, almost overnight. Seemed like a great idea. The trouble is, it didn't provide the fiscal discipline, provided just the opposite. Provided a blank check for the weaker countries, the countries that had been weaker in terms of fiscal discipline, to issue debt. Investors crowded into these debts because they believed that no matter what anybody said, that if any of these individual countries got into trouble, the European Union and the European Central Bank would come to the rescue. Okay? So if I can get a few more basis points on an Italian bond versus a Bund, a German bond, I'll take that, because not so much because I trust Italy any more than I did before when they had their own currency, but because I thought there was somebody standing behind them that had very deep pockets. This was not a surprise to anybody. The Germans recognized they were taking their risk when they put this whole system together, and so they wrote down on pieces of paper, "We will not bail out these other guys," right? And that's on page 1. On page 6 again, it says, "We will not bail out these other guys." It says it about 15 times, okay? You can say anything. You can write down anything as a piece of paper. In fact, the market chose to believe it, I think, because they anticipated a bailout, and in fact, that's what's going to happen. Okay, the incentive problem is really well known. If you've ever gone to dinner with a bunch of economists, you'll know that it's very dangerous to agree ex ante to split the bill evenly. Why? What do you do when everybody's going to split the bill evenly? You order from the right-hand side of the menu. You take the most expensive of everything, because your marginal cost is small relative to everybody else's. You've got to get the average cost. When everybody does that, obviously you get a very big bill. Right? This is the incentive problem when everybody is in the same bond market. Everybody's going to issue bonds into this market. If we're all jointly responsible for those bonds, I'm going to issue a lot of bonds, especially if I'm a little guy, if I'm a Greece or a Portugal or somebody like that. Suddenly this world opens to me, and I go nuts. Even better, that's the obvious part of it. But even more is that when the bill actually comes, what happens? They pay it, right? Because it'd be very embarrassing to get thrown out of the restaurant by claiming that the other guy didn't live up to his part of the agreement. So in fact, the incentives, once everybody is overspent, there's a very strong incentive in the mutual interest of all the participants, and this is what's going on right now in the Euro system, to bail the weak guys out. Right? It's actually, and everybody knows that. If everyone knows that from the beginning, you get what we've got, which is a mess. Okay, a little bit about mechanics. What's the immediate reason why Portugal, Greece, Italy, Ireland, Spain, are problems for Germany. There's two big reasons. One is that the cross holdings of the sovereign debt are very large. For example, French banks own a lot of Greek government debt. German banks own a lot of Spanish government debt, and so on and so forth. Because if you're a government and another government comes to ask you for help in supporting their bonds, and your banks hold the bonds, it's obviously in your interest to help, right? Because if your banks fail, you're in trouble too. So the other is less well known, but much more powerful, and that is the European Central Bank has an open-ended commitment to finance capital flight from any of the member countries. This is called a target system of clearing. And it's just like a Federal Reserve District. If there's an unfavorable clearing balance between the Federal Reserve Bank of New York and the Federal Reserve Bank of Chicago, the Federal Reserve Bank of New York automatically extends credit with collateral, but extends credit to the other Federal Reserve District. Not many people know this, but in Europe they have exactly the same system. It's called the Target 2 system. And it is now trillions of dollars. Okay, so everything you've read about in the newspaper about this new facility, which has just been voted on and to supply credit or support, pales in comparison with the transfers that have already been made through the European banking system, the European Central Bank. So it's an immediate problem for the other members. They can't avoid this. So what's the? Let's move to the current mess because we've got to move fast. Okay. So where are we? Well, we're in a system where devaluation is impossible. You can't devalue a single currency. So the easy way to get out of debt problems in the past simply is not open. Remember, they did that on purpose so they wouldn't get into this position. You know, that's like saying to somebody, I'm not going to do this, and to guarantee I'm not going to do this, I'm going to shoot myself in the head if I do. The trouble with that is occasionally you're going to have to shoot yourself in the head because bad thing happens. So that's weird. So the easy thing, like taking an aspirin, we can't do that anymore. In fact, not only we literally can't do it. I mean, it's technologically we've taken away that default mechanism. Currency, now there is a way to get out of the common currency, but the only way to do that is to reissue your old currency. Two problems. Nobody knows how that would work, right? Can you hold the question, or is it clarified?
About issuing a new one amongst the core European countries and leaving the only ones in. It would be another possibility.
Sure. Okay. So we could have two currencies, or three, or seven, or whatever. We could go back to the system. The trouble with that is, one, nobody knows what that would cost. The main beneficiaries would be the lawyers, and as much as I like Khan, right? I mean, trying to figure out if a German company in Greece issued a euro-denominated security held by a French bank, who would get paid and who wouldn't? The lawyers will be at it. It'll take 100 years for them to figure it out. There'll be a new Magna Carta before they figures that out. The lawyers will get paid first, up front, yes, okay, in euros, in German euros, no doubt. But even, so on the surface of it, it looks like it would be a very expensive alternative, very, very tough to do, and we don't know. There's a huge uncertainty, so it's a nightmare. The third normal reaction to debt issues would be, to change your own monetary policy. But there's only one monetary policy in a monetary union. It's got to be the same for Germany as it is for Greece. Germany actually has tended to control the ECB board, but even they have relinquished this right. But monetary policy can't give a differential response to the countries that are in trouble. That leaves only one, which is fiscal adjustment. Right? If you've issued too much debt, you can pay it back. Sounds simple, right? If you overextend your credit card, you quit spending so much, or you make more, or you take a second job and you pay it off. That's where we are right now. Okay, so the Germans have said, and the Europeans in general, the creditor countries, has said to the countries who have lots of debt, the periphery countries, you must increase your tax receipts, you must cut spending, and in that way you'll regain market confidence, and we'll get out of this together. The shorthand for that is austerity. You got yourself into this problem, you can get yourself out. Okay? There's a really one good, obvious reason why this doesn't work. Okay? And that is, to put a kind of a fancy way, there's no way a country can commit to do this. It can promise to do it, but it can't really commit to do it. So that if you're the Greek finance minister right now, or the Spanish finance minister, who is much less willing to promise anything, apparently, you can promise to cut spending, and you can promise to raise taxes, but you have an unemployment rate of 25%. You've got output collapsing around you, and therefore tax receipts collapsing around you. Your promises are not going to impress the bond market. People holding your securities are going to say, I don't care how sincere this government is about changing its fiscal balance. We don't think they can do it. Or we don't think they will do it. As long as we don't think they will do it, we'll charge them a default premium on their existing debt. So forgive me, we got to go into a little tiny bit of math here. Okay? So these things blow up when what's called the debt-to-GDP ratio starts to explode. Okay, so let's say your debt initially is 100% of GDP, which means that the stock of debt outstanding, government debt, is equal to 1 year's output, which is about where most of these countries are, including the one you live in. It's getting there very fast, 10% a year right now. But anyway, okay. If I, as an investor, think there's a 1 in 20 chance you'll default on that at some point in the future, right? I got to charge you a 5% premium to hold that debt, 500 basis point premium. Okay? Now let's just think about that 500 basis point premium. That came from out of the blue, right? There was no change in the stock. There was just a change in the market's expectations about your future behavior, that is the government's future behavior. Now, to keep the debt-GDP ratio, if there's no growth in GDP, the debt is going to grow then by the risk-free interest rate, say 2% plus 5% risk premium, 7% right now for France, for Spain. The French wouldn't like that if I said that. It's only 3% for Spain. Anyway, for Spain, I have to then generate 7% of GDP just to pay the interest on my debt, to keep it constant. Okay, so if my debt is constant at, say, 100 euros a year, if I have 100 euro debt, I'm paying 7% on that euro debt, and I don't pay any of the interest. I borrow the interest back. That is, I don't run any fiscal surpluses. Then my debt goes up by 7% a year. So next year, I have a debt of 107. GDP is still 7 because my GDP is not growing for reasons we'll get into in a minute. Next year, it'll go to that compounded, 115, but the risk premium will go up again, and so it'll actually go to 120. And it's very, very easy with this feedback mechanism from the stock of debt to the risk premium to get an explosive system, right, where the debt just rises geometrically. And I've done 1,000 of these in the 80s for Latin American countries, now for European countries. That's the feedback that kills you. It's not what you do today. It's what you promise to do today isn't believed. People therefore charge you this higher interest rate. Now the thing is, how does a government generate 7% of GDP? That means taxes have to be 7% higher than expenditures. Okay? Look through history. You won't find any countries that have done that for more than a couple of years. So you just appeal to history, right? They say, okay, once the risk premium gets in there, if the initial stock of debt is high enough, you get enough additional debt so that the fiscal effort required to just stabilize it relative to GDP is all out of all historical experience. Right? That's when countries blow up. And what's fascinating about it is it happens really fast because nothing's really changed, right? The only thing that's changed are people's expectations about what you're going to do in the future. In the meantime, why doesn't the country grow? Well, that's your next picture at the bottom of the page. These are Eurozone corporate lending rates. Now remember, it's the governments that get into trouble, but the corporates borrow in the same market. And a corporate in Spain is polluted or is contagious if the government of Spain has thought that they can't pay their bills. The market will immediately come to the conclusion that the government of Spain may well step in and keep big Spanish corporations from paying their bills too. This has happened in every default, every modern default. So the problems for the sovereign, the government, go right to the corporates. As you can see, these corporate lending rates converged up until the 2008 crisis. That's the peak there. They all fell like a rock, but now there's a tremendous amount of dispersion. Remember, if you only remember one point, or only bring one point out of here, is how would you characterize monetary policy in the Euro region right now? Well, what is monetary policy? It has something to do with controlling interest rates, right? How do you control interest rates when you have this kind of dispersion among interest rates within the region? You don't. So when Mario Draghi a couple weeks ago said the ECB has lost control of monetary policy in Europe, that's what he meant. Mario is my contemporary. He was educated across the river. He's one smart cookie. So he has identified this, saying, okay, I'm now the head of this central bank, and I have completely lost control of monetary policy in the Eurozone because we have all these different interest rates out there, right? And I don't only control the risk-free rate, which is basically the German rate, which I've set it at 0. So I'm out of business, okay? Oh dear, so we got no fiscal policy, we got no monetary policy, and we got no exchange rate policy. Oh, that's the end of that talk. I have nothing else to offer. Well, wait a minute, I know, I still have a solution. Okay, before I get to the solution, the next picture is just to show you how bad things are. The Euro coin index is just a leading index, a leading indicator index for Europe, put out by an outfit in the UK. As you can see, the last blue bar we have there, the GDP, was last year's. But these coincident indicators that we have more recently are headed south, big time. The scary thing is there's no reason to believe that rate of decline should change. There's no reason to believe that rate of decline should change. Look at the IMF's forecast for European activity, the OECD's forecast for European activity. They're fairy tales. This thing is going to keep going down. Okay, so now we're in a sinking ship with no rudder, no engine, no propeller, no paddles. What do you do? Well, two choices. One is that you, in spite of everything everybody said, you borrow all the money you need from the European Union. Okay? That's sometimes called the kicking the can down the road scenario. What that means is, essentially, is the private sector, which has been holding your sovereign debt, is slowly, over time, replaced by official lenders as the private debt comes due. Right? So if I have a Spanish bond right now, I can sell it to another private sector person, but I can't sell it back to the Spanish government until it matures, right? So we sell it among ourselves at a big discount. But the governments can come in as the debts mature, instead of having to allow the Spanish and the Italian and the Greek government, Portuguese government, to repay it. The ECB or the European Union will lend them the money, and they will pay it. Now, how that works is shown in this bottom table here. This is from a paper I did after the 80s debt crisis. And it shows quite remarkably that although we didn't really understand it much at the time, what happened in the 80s to the Latin American countries was that they paid off their private creditors with money coming from the official sector. And they did it for 10 years. So as you can see, the first column of numbers goes down. Commercial banks, who were the major lenders in that episode, not the bond markets, went down. The liabilities to official creditors went up. Basically what that means is the official creditors, the U.S. government and the IMF and other people, loaned money to the Latin American countries so they could pay the banks back. Now, in whose interest is that solution? Well, it certainly wasn't the countries, because the countries didn't grow at all. It's called the lost decade of economic growth in Latin America and the other emerging markets. Certainly wasn't a great win for the U.S. government, although it did spread over time the loans that the U.S. government had to make to Latin American countries, so it wasn't such a politically sensitive issue. There wasn't a 20, 30, 40, $50 billion transfer. There was a small chunks of money that went, over time. That's the solution. That's the trajectory on which we are right now in Europe. There will be no private sector finance for periphery European countries for 20 years, given the current what's going on right now. What will happen is that over time, the German and the stronger governments will do slowly what they're unwilling to do quickly. They're unwilling to bail these guys out with a big chunk of money now, because that would be very unpopular with their voters. So they'll do it under the tables in some sense. There'll be a slow leakage. Okay? In the meantime, the people in the peripheral countries will suffer terribly. Okay? That's a very stable, politically, bad solution. That's where we're headed. That's the one that which is most likely. The obvious alternative is you just default outright on the sovereign debt, but stay in the union. Okay? That's what Greece did, essentially. The Greek so-called exchange of new bonds for the private sector's old bonds was really a default on the old bonds. Private creditors only got 10, 15% on their investment. And now the official sector has just taken over. They did it all at once. The whole outlook for Greece now depends on the generosity and the terms on which they get from the European Union for the continued borrowing, which has been more or less promised. There's an interesting, also bad equilibrium there also. Okay, you've got the private sector out. They're no longer interested in this game at all. There's a few hedge funds that have the stuff. Of course, my hedge fund sold it at exactly the wrong time, but that's because I know too much. The other guys who bought it from me, the dirty rats, they're actually making money now on it. But that's my problem. That's a personal issue. Important issue, but a personal issue. But it's a very bad solution, and that we'll have this ongoing political struggle, where the authorities in the surplus countries demand austerity. The decision makers in the periphery countries have given up now, at least in Greece, returning to the private market. Given that the severity of their default, there's no way they get back in the private market for a very long time. And so we'll have this political equilibrium for a long time, probably drawing it out for a long time. As with any sort of debtor bankruptcy problem, the efficient solution is to forgive the debt now. What's going to happen, I'm afraid, is the private debt will be taken out by the official sector. The official sector will forgive it, but it'll take 10, 15 years. In the meantime, the fuse which is burning is in the peripheral countries. How long do they put up with this? This game is not in their interest. When they figure it out, this is what happened in Mexico. In 1986, the Mexicans said, no mas. We're not paying you anymore. And that's when things actually got negotiated and things got resolved. That's not on the horizon yet, unfortunately. Okay, so what are we doing with time? Okay, so two things are, two kind of extensions of this discouraging outlook is, well, it's curious that we have all this trouble, but the euro as a currency has remained pretty strong. There's been predictions that the euro would collapse, right? The euro value relative to the U.S. dollar would fall in value dramatically because it's now this mess in Europe. In fact, the euro's been pretty strong, and I've been trying to understand that. And I think there are two explanations. One is a pretty standard way of looking at the world. The euro as a region, in terms of balance of payments, current account imbalances, borrowing and lending among countries, the euro as a region was pretty neutral. Okay, so as you all know the story, the U.S. has been a big borrower. China has been a big lender. Europe has been sort of in the middle as neutral. Okay? But within Europe, there were very big imbalances. The Germans and a few of the other strong countries had very big current account surpluses. The periphery countries had very big current account deficits through 2008. Now, if you look forward, for a country to run, like Greece, to run a current account deficit, you've got to be able to borrow from somebody. Right? You can't spend more than you take in unless you borrow it from somebody. They can't borrow from the private sector, and they're not going to be able to borrow very much from the official sector. So their balance of payments will be forced toward balance. It's already happened. The Germans, on the other hand, will continue to run pretty big surpluses. So the euro area will go from about a balanced area in terms of net capital flows to being an area with a surplus, like China. That leaves us. The U.S. is the only deficit region, the only significant deficit region in the world, and that most traders or most observers would suggest a weak dollar and a strong euro. As we build up more and more debt, we have to make we have to make larger and larger interest payments to the rest of the world. We'll need a devalued currency in order to generate that revenue. So that may be one reason why the euro has remained strong. To give you an idea of the quantitative importance of this, the bottom picture here was a projection made at the IMF before the European crisis. And I just want to call your attention to below the line there, the big red bar is the United States. That's a big deficit region. We borrow, we live beyond our means. But the yellow bar below that was what the IMF thought the peripheral countries in Europe would borrow off through 2014. See, it's almost as big as us. And so this was a region, these were big-time borrowers, okay? So one of the things, we've taken some, as big as the United States, we've taken them out of the equation. If we did this forecast now, that yellow bar would disappear. Okay, well, something's got to give, right, in a world where you've got this kind of a rearrangement of lending and borrowing relationships. Most of those arguments would argue for a stronger euro, which is kind of what we've seen. The other is an argument or a factor which I see a lot of in talking to people in financial markets and so on and so forth. Why would big government debts lead to maybe a weaker currency? Well, one reason is the central bank has to support the government debt by buying it. That forces down interest rates, generates inflation. Both low interest rates and inflation expectations lead to a weaker currency. And in fact, the European Central Bank is producing lots of money and very low interest rates. But so is everybody else. Okay, so exchange rates are relative things. If you look at the top there, major central banks have printed almost $9 trillion since 2007. Okay, think of it, $9 trillion in money. Okay, how in the world did they get away with that without any inflation? Not just in Europe, but also here at the Federal Reserve. Why, the huge increase in the Federal Reserve's balance sheet has meant that so what the Fed does and what the European Central Bank, let's say the European Central Bank is a little more dramatic. The European Central Bank goes into the market and buys a Spanish government bond, okay, which is yielding whatever it's yielding. and they sell a liability of the European Central Bank, which is money. They pay zero on it. It's a short-term liability of the European Central Bank. The interest rate on that is zero. It looks just like money. It looks like high-powered money, as a matter of fact, central bank money. Why doesn't that cause inflation? Well, one of the reasons it doesn't cause inflation is that all the short-term government bonds pay zero right now. So when you think of it, there's really not much difference between the liability of the European Central Bank, which pays zero, and the liability of, say, the Bundesbank or the German Bund that pays zero. So the distinction between money and assets has gone away because of zero interest rates. And so we've got people associate the problems in Europe and problems in the United States with an inflationary impulse, but we're not seeing any of it. And for technical reasons, I just don't think it's a threat. This can be reversed overnight. All you have to do is start paying interest on those reserves, and you've got the biggest contractionary open market operation in history. Right? So for technical reasons, it's not really an issue. And the bottom chart just shows that. It has a scatter diagram on money creation and interest rates. There's no relationship anymore. Okay, so I think I'm out of pictures. Why don't I stop there? So to summarize it, I think there are still strong incentives for people to stay in the Euro system. I think they probably will for the most part. If there are exits, it'll come from the streets. It'll come from the people in the peripheral countries who say, this system is not in our interest. I actually regard it as somewhat unfortunate that the governments involved will find, sort of kicking the can down the road, a slow substitution of private for official debt and a very slow recovery, an acceptable equilibrium. In a way, that's too bad. Like in any bankruptcy proceeding or any sensible financial system, when you got people that can't pay their bills, it's better to resolve it and move on from both sides and move on from there. But we don't have a political process that will do that. So this is going to be around for a long time, and it's an unfortunate equilibrium. Okay?
Questions? I don't see 30 hands, but I see enough. Yes.
I'm John Harris from the Economics Department. Really enjoyed your presentation. The one issue that strikes me is you began by describing this all as coming from fiscal irresponsibility. If you look back, Ireland was running surpluses, Spain was running surpluses, but the only one of the countries that really fit this thing that it was fiscal irresponsibility that led was Greece. It really stands virtually alone. And therefore, these huge debts that these other countries have now was because of the failure of the private banking system, and then the bailout, the absorbing those losses, turning them into government debt. And maybe if you got the debt, then you have to deal with it from here. But it strikes me so much that a lot of the analysis, and particularly on the austerity, comes in part from a misunderstanding of what caused the crisis.
Yeah, that's a valid point, and it's one. So the point for non-economics department people is that a lot of the government debt that makes up that 100% now wasn't because of sort of standard fiscal deficits. It was because the banks loaned money to people who built houses that nobody wanted. The banks then failed, or the banks had to be bailed out by the governments. So the government had to issue debt in order to give the money to the banks so the banks could repay their creditors, right? And that's true, and it's true particularly for Ireland. I mean, that's the poster child for this, where they had a wild expansion of the banking. In Spain, I'm not as convinced as most people are. In Spain, the change in the fiscal, you're right, through 2006, Spain was really virtuous. They had like 30% debt, and they went south really fast for both reasons, both because of spending that, and now with the downturn in activity, again, you've got social safety net payments to make, unemployment payments to make, and your tax revenues fall like a rock. Okay, so yeah, it actually was on one of my slides, which I skipped, is that big increases in debt often come from banking, financial market breakdowns, right, and from wars, and then following financial market catastrophes, like in the U.S., then you have what the U.S. debt is going up at 10% a year because of the fallen output, which followed the financial crisis, right? So these things they're all jumbled together, but very often the initial impulse is a financial market breakdown, and that's also true. And so we certainly contributed to that, right? Our financial breakdown contributed to the losses that we're seeing now in these various systems. It's good. No problem with that at all.
Someone over here had their hand up first. Yes.
I just wanted to ask about a hypothetical situation. What if the Germany, who has a strong surplus, goes out of the euro currency and let its old mark appreciate, so that the other default nations like Greece and Spain can still export and like produce? Why don't we consider this option?
Oh, the Germans have considered it. Very quietly, because if it got out that they were entertaining that seriously, there would be an immediate speculative attack on everybody else, and the game would be over. Let me tell you the completely non-economic reason for that, and so I don't want to name drop. In this case, it might actually be useful. The head of the Bundesbank resigned. Axel Weber resigned from the ECB Council. ECB board, because they started buying bonds, okay, and he thought that was the end of the world, so he resigned. And I asked him the same question. You know, it looks to me like if this thing's going to blow up, it makes more sense to Germany to leave than the other guys to leave, right? And he said they would never do that for political reasons, ever. It's a hypothetical question. It's an interesting one, but his view, and he's pretty well connected in German government, is that that ain't going to happen.
Just one more quick question, which is, what is the exposure of the United States funds, money market funds or mutual funds, to the European banks? Will they be really affected?
It was very large 2 years ago, okay, and it was the number. I don't know. Are you an economics guy or? Huizen Shin has this paper where he suggests that it could be as much as $3 trillion. Okay, so $3 trillion is the exposure, is what European banks have done in the U.S. market. Now, what that means is they borrow the money in the U.S. market and they lend it in the U.S. market. So these are not cross-border. This is not $3 trillion being loaned to the United States. It's just the activities, I work for Deutsche Bank, right? So the activities of European banks in the U.S. is very, very large. It's a big part of the secondary market, right? The non-bank market. Shin's point is, if there's a sudden failure of those banks, that they would have to withdraw from both sides of the U.S. market, the asset and the liability side. Now, in principle, business could be taken over by other people, but it wouldn't be on one day. Right? So it would be a heck of a shock. Now, U.S. institutions, knowing that, have I think pretty much insulated themselves from it. In other words, they've got alternatives. These are very liquid funds, right? So they've got alternatives. Like the U.S. money market funds were the ones that were probably most vulnerable, and I think they're almost completely out of that business.
Fantastic presentation. Thanks so much. I would like to make 2 points relative to your presentation. The first is that another story of convergence is the one that refers to the transformation of the sovereign bond markets into markets for collateral. The majority of the collateral used by the interbank market in Europe comes in the form of sovereign bonds.
Sovereign bonds, yeah.
Yeah, they were priced by clearinghouses at the same value. So. Would you agree that this is another very powerful source of pressure towards fiscal consolidation? Because fiscal consolidation becomes a mechanism to stabilize the banking sector, which had become extremely transnationalized. Yeah. And the related point is that the European banking sector is way too big to bail compared to the US one. Their exposure into these kinds of risks per GDP is considerably higher than the U.S. banking sector's was in 2008. So what do you say about these points that some people have thrown out there?
The first point I think is a really good one, that the unification of collateral requirements and collateral rules, not just in Europe, but because of Basel, too, all over the world, had a lot to do with the integration of the systems and therefore the convergence. So I think that's right. The second one, I'm not so sure. I mean, this is a huge issue, and there's a lot of debate on it, a lot of money changing hands on it, and it is, you know, can the ECB support all of these bond markets? And I think the answer is yes. I mean, look, the ECB can issue an unlimited quantity of ECB liabilities, and if you look at the solvency of the European Central Bank itself, it's pretty much unquestioned, right? So can the European Central Bank replace the entire bond market, existing bond market for Spanish sovereign debt and Italian sovereign debt? I think the technical answer to that is yes, they can. Whether they will or not is another issue. But I think they're clearly they have clearly gone down that road. There was this very, very important day in which, again, Mario Draghi came out and said that he was committed to stabilizing the euro and recapturing monetary policy. And I'm pretty sure that he would not have said that unless he had an explicit handshake agreement with the German government that he could ignore the Bundesbank and go ahead and do that. So I think they're down that road, right? The European Central Bank has taken the same level of responsibility that the Federal Reserve has for the U.S. And you know, they haven't said that, but their actions are only, in my view, are only consistent with that interpretation. But boy, if that's wrong, we're going to be in serious trouble fast, because that system will collapse without that.
Hi, I teach international politics, so let me ask you a political question. Given
I'm an amateur, but go ahead.
Okay. Given the German reluctance to finance a Greek bailout, and given German concerns with moral hazard, and given the German domestic political fear of contempt for, really, Greece and Greek politics, how do you explain the recent inclination of Angela Merkel to support Greece in the European Union?
I think she has been convinced that she has no alternative by the economists. I think the economists have said, including Draghi, and have sat down with her. She's a physicist after all, right? I think if I had her in a room as a captive audience for 4 hours, I could convince her that there were no other options. I mean, to throw Greece out puts Spain right on the firing line. So if you think you're wasting money in Greece, right? Now you're talking about a Spanish economy, which is what, 7th biggest in the world. Now we're talking real money. As Everett Dirksen said, you know, a million here, a million there can add up to real money. A billion here, a billion here can add up to real money. Well, we're talking about a trillion here and a trillion there adding up to real money. So I don't think she has any choice. And you know, as you say, the German politics, or she has to also deal with that. But the benefits at this point of throwing Greece out are zero, and the costs are enormous. Right?
Hi, my name is Haywon, and I'm a student at Banking LLM. And I'm curious, do you think that England made a wise decision when they chose to keep their pound? And do you think that we would have like better or worse picture if England was involved more actively in this situation?
What was the last part?
Like if England was actively involved.
was more active in it? I think they made a very wise decision because they were able to maintain the city of London as the center of finance instead of moving to Frankfurt and avoid those rules, which is a big part of their national income. I don't. Look, England's a small offshore market. They can't actually do anything. so I think if it's like a gas station. You you stop and you fill up with gas and you go somewhere else, right? So I don't think they have much of an impact on what's going on. From their own point of view, though, it was a very wise decision to stay out. Actually, I stole that line from Rudy Dornbush. He used to say that Venezuela was a gas station south of Miami.
Well, before we offend anybody else, anybody here from Venezuela? Yeah, one last question right here.
As you said, the European Central Bank could not replace all the Italian and Spanish debt with theirs. Whether I'm doing it, if it could help really the Spanish and Italian economy. I mean, if Spain
Okay.
cannot even persuade the European Union, how can it persuade the markets?
Okay. It can't persuade me to, but it can say that if they, when I said Mario Draghi said they want to regain control over monetary policy, that's exactly what he meant. It means that he's going to intervene in those markets to kill me if I sell them. Okay? So if I sell one of those markets short, and he comes in and supports the price, I lose money, right? So he's a threat. He's a big dog. He's a big dog in this. So if he says the spread on Spanish bonds ought to be 200 basis points, I don't really care why he says it, but I listen. It's like the guy in the advertisement when he talks, people listen. Okay, that's why. He doesn't even actually have to do it. He just has to convince me that he will do it. And I'll keep those spreads about where he wants them. So it's a very delicate thing, right? So the central bank doesn't actually have to do anything. It just has to convince you that if you take a position on the other side, they'll kill you. That's very powerful. Believe me, I suffered. I have the bruises.
I'll exercise the prerogative of the moderator to ask one last question. That has to do with your comment that the Greek situation where the debt was haircutted was a default.
Yes.
And the world recognized it as such. But I believe the International Swaps and Derivatives Association ruled that it wasn't not a default.
The second one was.
Yeah.
Okay, so in the end, look, the credit default swaps were activated after the exchange. They weren't before. Okay, so there was this long, as you know, what happens is people go to that group and they say they did this, is it a default or not? So if you have a credit default swap, it's activated if there's an act of default. Well, how do you know there's an act of default? Well, you go ask this committee. Who sits on the committee? Same people that write the credit default swaps. A little strange. So I got to go ask. So if this guy has sold me a credit default swap, which is worthless unless there's an act of default, I got to go ask him if there's a default. What's he going to say? No. And they said no several times. In the end, they gave in.
And these are the same people that brought us LIBOR.
Yes.
Right. Okay.
Exactly the same people. Exactly. The same subset of people plus some hedge funds.
I feel much better. Some people have a gift for translating highly complex topics into understandable concepts, and you clearly have that gift, Professor Dooley. So I want to thank you for being here today. I do not have a gift even for clear memory because I had a presentation that I wanted to give to him, but I forgot to bring it with me today. So that is back in my office. So thank you again.
Okay.
Before you all leave, I just want to mention that we have an event coming up in a couple of weeks. You have your notices. Neil Borofsky is the former Special Inspector General for TARP, also known as SIG-TARP. He has just written a book called Bailout, highly regarded book, highly inflammatory book, and I think you'll enjoy reading the book. And on November 8th, if you care to join us, at the Law Tower in room 1570. That promises to be a very interesting presentation. We have a number of exciting speakers that we are planning for your benefit for the spring term, so you'll be receiving notices about that, anybody that signed up for this presentation. And if I heard Professor Dooley correctly, he indicated that he was going to get Mario Draghi here in the spring to talk to us. Did I hear that right?
I think that's a exaggeration.
Exaggeration. Okay, so then he'll be here right after Thanksgiving. Okay, thank you for coming. It was enjoyable. I hope you enjoyed it.